Let's kickstart the first conversation of the day, and this will be a bit of a explainer, or a bit of a segment that will help you understand the key nature of passive investing. When is it used, and which of the two options that are available, primary options that are available, you should choose. Joining me now is Sanotsh Navlani, who's the Chief Operating Officer of ET Money. Thank you so much, Santosh, for taking the time, and good evening to you. Let's first talk about active versus passive. We've spoken about this before, but let's run through it so that everybody who's hearing about this for the first time understands what we're talking about. Why would you choose passive over active when it comes to equity investing?
Hey Alex, hi. There are probably two ways to invest, as we have discussed multiple times in the past, active and passive route. We can't understand passive without understanding active here. So for the sake of explanation, I will just run past what active means. So active fund management means that you're giving your money to a fund manager who's actually kind of adept at managing one's money. He or she can actually understand how to pick up which sector of the economy is going to do well, what kind of stocks he or she needs to buy to build a portfolio which can withstand the stand of the time, or the volatility on the marketplace, and generate returns which actually goes and beats the broader benchmarks like Nifty, Sensex, Nifty 500, and so on and so forth. So a fund manager basically decides what kind of returns he's going to target. He then decides what kind of benchmark he will be judged against, and goes and tries to beat that benchmark so that he actually can charge a fees to have a superior performance over the benchmark. So that's an active way of managing money. India has always seen a healthy, or rather more preferred route to invest in active management, because India was not really a very efficient market in the earlier time place. And over a period of time, what we have seen, India is actually mimicking the behavior what developed economies have, where the fund managers over a period of time struggle to consistently beat the benchmarks like Nifty, Sensex, or Nifty 500. So what is happening today is there are a plethora of options available where, as an investor like a layman, I'm putting my money at work. I, as a user or investor, may not be able to decide which kind of active fund manager, which fund house, which scheme is going to outperform in the future. I don't care about the past. And instead of taking a wrong decision, going to an active fund manager who may not be able to beat the benchmark, I simply become satisfied with just mirroring the returns of the benchmark like Nifty and Sensex. So what happens here is you choose the benchmark that you want to invest in, a Nifty 50 fund, or a Sensex fund, or a Nifty 500 fund, or a mid cap and small cap index funds. I put money there, the fund manager over there, without applying a lot of biases towards building a portfolio. He just creates a portfolio where same amount of stocks in similar ratios and weightages are bought and given to you as a portfolio. And on a daily basis, the performance of that portfolio will end up mimicking the returns of Sensex and Nifty and broader benchmark that you're choosing for. So what happens in passive, over a period of time, you realize that you don't really outperform the benchmark, but you mirror it. Hence, chances are very high at times that you will notice that you actually beat many of the active fund managers over a period of time. And possibly is a better way to invest in today's times than what it has been in the past.
Consistency is obviously key, because the long-term averages, more than anything else, very hard for an active fund manager to beat the benchmark over that protracted period of time, and that's what you have to use to your advantage as an investor, right? But two key ways, Santosh, to invest in passive, mutual funds. There's an ETF route, which is more flexible, but also comes with its share of challenges. And there's the index fund route. How do you differentiate between the two?
So both are really equally compelling ways to invest as a passive investor, in my opinion, Alex. I wouldn't really say that one is definitely better over the other. There are pros and cons in both of them. We can understand one by one. So the basic difference between them is an index fund is typically offered by the mutual fund company without the need of opening a demat account, and it exactly works like how mutual fund works, which means that you basically get allotted units at the price, which is the closing price of the day, like the way mutual funds allot unit to you at the closing NAV of the day. you basically allotted units. You can invest in terms of amounts which you are used to, and there is no need to open a demat account for it. You can buy it from the mutual fund distributor, mutual fund company's website, apps like ET Money, and kind of manage your money simply by putting money in index funds. ETF has slightly different ways to approach. It's almost like a stock getting traded in the stock market, where the price is not exactly given to you as per end of day closing price. It's basically determined by the seller who's selling it to you. So unlike an index fund, which you actually buy from a mutual fund company, ETF you end up buying from a layman investor like you and me. So you go to to your brokerage account, you log in, you basically decide how many units of an ETF you need to invest in, and you basically punch in an order and you get units allotted to you. And this unit can basically depend on prices which are different at different points of time in the marketplace. The advantage over here is that you basically choose to demand a price in that sense. So if for example you say that the market is actually down by 2% at 12 noon, and you basically buy at that point of time, and if the market recovers by 3:30 p.m. When the market closes back to the level it was, then an index fund investor will actually get at the closing price, but you as an ETF investor will probably get at 12 noon at a 2% lesser price. So if you are somebody who's actually can track markets closely, you can take advantage of investing via ETF route versus index fund route. So that's just point number, which is price. And second important aspect is the tracking error, which is kind of a reality in a passive investing world, where your returns may not be exactly same as the benchmark because of the expense ratios involved. Now, what happens in ETFs? The expense ratio is slightly lesser compared to index funds. So as an investor, when you buy ETFs, you will probably see that the tracking difference that you see between the benchmark returns and your own returns, and over a period of time, tracking error that you will notice in terms of variations in your performance will be lesser compared to an index fund investor. This primarily is because the expense ratio of ETF is lesser than index funds. Second is index funds actually hold some kind of cash in their portfolios all the time. And because of the cash holding, they provide liquidity to you. And because of that, the returns actually tend to be slightly lower because of that aspect as well. So barring these two differences, where you can actually buy during a daytime at a different price, and second aspect, the tracking error and a difference, broadly, these tend to give you same kind of experiences over a bit of time.
Okay, so that's well put. Just wondering though, when you talk about the cost aspect, and this is one of the reasons why people choose passive investing over active, because the total expense ratio of an actively managed fund almost always, in fact always, will be more than a passively managed fund because of the element of the person who's managing the active fund, and that person has to be compensated. But between the two, index versus ETF, a lot of people say that for the more liquid ETFs, the ETF is actually a better way to invest because of the cost aspect. Is that always true though?
It is true, Alex, in an ideal world. So what happens is when you basically go to the exchange through your broker and want to buy a unit of ETF, chances are very high that there will be some kind of difference between the real price, which is called as an INAV, which is basically indicative NAV at that point of time. And as an ETF provider, the mutual fund companies have to declare, as per latest regulations, the indicative NAV every 15 seconds for equity funds, and about 4 times in a day for debt funds. So what an indicative NAV means, as a user or as an investor, I may not know what is the right price of this ETF, because if Nifty is up by 1% or down by 1%, I wouldn't know how the underlying weightages of stocks at this point of time in this ETF are, and what kind of price is right for it. So we may expect that if Nifty is up by 1%, the ETF should be just about up by 1% as well, which doesn't happen in real life, because what happens is the liquidity provider in an ETF is not the mutual fund company, but it is the market maker. So market maker is somebody who's basically responsible for ensuring that there is healthy amount of buying and selling happening in the ETF, so that when an Alex goes to buy the unit of an ETF, the price he is going to pay should not be excessively higher than 1% higher of Nifty. So and hence a market maker has a price to provide that liquidity to you. So chances are very high that you probably see if Nifty is up by 1%, the ETF will be trading up by like 1.18, 1.2%. So that cost you'll end up paying, it is called impact cost. So impact cost, basically, if you're buying something higher than its underlying price, it's basically going to be an impact cost in your portfolio. And if you're selling something at a discount to the underlying price, then you'd be again impact cost to you. So these impact cost in ETFs eats into the returns. And coupled with that ETF impact cost, there is a brokerage cost that you will end up paying. There's depository charges you'll end up paying for trading into ETF units. There is going to be like demat annual fees that you end up paying. So these costs, in my opinion, between ETF and index will nullify the short-term impact of cost that you're going to have by buying ETF in terms of expending more over an index fund versus actually expecting that it's going to be exactly same. So that cost is there, but over a period of time, if you hold the ETF for a long period of time, like 2 years, 3 years, 4 years, 10 years, then because the ETFs are cheaper in terms of annual expense ratio than index fund, you possibly will be making more money on ETF than on index fund. Slightly higher, I would say.
Okay, interesting. So with that in mind, then from the perspective of the investor, of course, again, you've pointed out numerous times, even on this conversation, that if you are a little bit more savvy and you're able to see where the market is moving, you're tracking it more regularly than you would normally track. I'm talking about the average investor, then maybe an ETF would be better. But which of the two, considering that you've just pointed out that tracking difference is lower on your ETF, it might just make you a little bit more money. Can it be said then that an ETF is better than an index fund in the passive investing strategy?
So if you are holding for like more than a few years, Alex, in my opinion, an ETF investor will actually make slightly more return in index fund. When I say slightly more, it may be like 0.1, 0.2, 0.3% higher, depending on number of years you are holding it for, but not beyond that. So if you're somebody who's investing small amounts of money via SIP route, which again ETF doesn't provide you that, because ETFs are bought in terms of number of units, vis-a-vis when you invest in SIP, you invest in an amount. So if you are somebody who's not an SIP investor, but looking to buy and hold for a long time and invest one time or sporadically in an ad hoc manner, then ETF may work for you. But if you're somebody who's an SIP investor and want to really automate the headache of buying every time on your own, because SIP will work seamlessly without you going to the brokerage account and making a trade. Or bit often the convenience will probably trump your extra return that ETF may be giving you. But again, as I said, it's also important that when the ETF investor is going to his brokerage account and making a purchase, he or she should be knowing the right price to put in. Because the indicative NAV and the actual price that you may be ending up paying, if you end up paying more than 0.4, 0.5% as an impact cost, then all the returns that you're going to make over a period of time, you have already given to the other buyer in terms of impact cost. So you have to be very, very careful about how you trade in ETF if you are trading in ETF. Otherwise, if you can, as you rightly said, if somebody who's very, very adept at market, understands trading, understands cost involved there, then he or she should be basically going on ETF route. But if you're an SIP investor, I would recommend stick to index funds.
That's the bottom line. Of course, in past conversations, Santosh, we've discussed various options within the basket of both index funds and ETFs. So this, I guess, is more of a strategy conversation, and this should give people a clearer perspective as to how to go about their passive strategy. Thank you so much for taking the time. Always a pleasure.
Thanks, Alex.